Good day everyone, my name is Dan or Erlon. This video belongs in the Money Management series. And to date in the Money Management series I've talked a lot about trading, and most of it, not all of it, but most of it has to do with trading. And I talk about trading quite a bit in the Money Management series. I say most of it, but not all of it, because those first principles, risk analysis, reward analysis, trade management, drawdown accuracies, those first principles, they do apply to investing as well. So in this video, I want to talk about money management from an investing basis, okay? So, number one thing really is that risk analysis rule. That's an excellent way to illustrate how those beginning principles of money management apply to investing. They apply, like risk analysis. You never take more than 3% of your funds and, contribute it to any particular stock. There's a little way to sort of build up to that point, because if you're starting off in the low funded position, you're like, okay, Dan, I've got like $500, so I'm just gonna buy 30 bucks. That doesn't make sense. So I'll get to that here in a bit. But yes, you can still apply risk management. You just have to do it a little differently. Okay. Okay. So, but it is possible. It is possible to build with low funds, and I just really want to stress that it is possible to build an investment portfolio starting off with low funds. And I'm going to say that again, and not buying cheap stocks. When I say cheap, I mean like penny stocks. I'm not talking, well, that stock is $35, so I can't buy it and I have low funds. Scratch that business right out. I'm going to say that again. It is very possible to start off with low funds and build a good dividend drip portfolio, and not looking to cheap stocks to do it. Okay? Obviously, you want dividends. So that should tell you something about the caliber of the portfolio that you're going to be dealing with. But dividends are the friend of the low-funded trader, or the low-funded investor. Excuse me, we're not talking, let's ixnay trading right out of this. Investor. If you are starting off with low funds, dividend stocks are your buddy. And a lot of people will see something going for 55 bucks and think, I can't buy it. No, wrong. It also relates to another thesis I have in another video that I'm probably going to have in the future that, are you ready? Because I'm a bit contrarian to what most people think. Buy and hold is not dead. Okay? Just want to put that out there. So, dividends. The thing is, if you're starting off low funded, you're going to have to add to your positions. What I mean is, okay, obviously your first enemy is going to be commissions, right? Let's say you buy a $55 stock, you buy $180 of it. Commissions is going to be such a large portion. But let's say this stock pays 48 cents per share once a quarter. So your dividends are helping you overcome that initial hit that you take off, probably in your first year, that initial hit that you took because of commissions. And always have it involved in a drip program. I always talk about that. Always make sure that the dividends are reinvested. Let's put it that way, that the dividends are reinvested. So, but the dividends will overcome that first crisis of commission that the low-funded investor deals with. And you want to diversify. So if you're going to spend, let's say, $180 on this stock, and you buy $180 worth of this stock, but you always want to have cash available. Okay? This is all sort of money management and investing. If you have to build, I had a video some time ago of how to build an investing account. Just treat yourself like you already have a $15,000 investment portfolio. You may not have $15,000, but just say, okay, let's just say it's $10,000, right? So I can spend 300 bucks on a stock because I have in my mind, a $10,000 portfolio. So just buy $300 worth of a stock, keep it there, turn the dividend reinvestment plan on. Make sure you still have cash. So if you spend $300, have another $300 ready there and ready to go. And also have some in a slush fund. You always have cash ready to go for investments. Always, always, always. So diversify, and then when you've got $300 and you've got, say, and you're going to see me do this with the challenge project. Let's say you have 4 stocks and they're each weighted around $180. And hopefully you always have cash in the background. For example, I have, I think, $45.40. That's soon to be bumped up. As well, I also have $64 ready to go. So, you know, there's over $100 right there, ready to go. There's always cash. Always, always, always have cash. That's like money management principle with investing. Always have cash ready to go. And you really want to build your cash position as well as your other positions. So, yeah, you can do it. You can do it with low funds. Just remember, don't forget about the dividends. You know, you buy a $30 stock and it's paying 50 or 60 cents for a dividend. Your commissions are going to be overcome in your first year. Let's say you want to hold it 5-6 years. There's still plenty of stocks out there. You know, Johnson & Johnson is doing fantastic lately. Coca-Cola, Pepsi, General Mills. These are companies that aren't going anywhere. The survivability, you know, is the name of the game with investing. But so if you start off with low funds, and that's who I try to market myself up to, like I had in that one video a while back, build your $10,000 or $15,000 portfolio. Build it slowly. Just act like you already have the $15,000 in cash, and it's like every now and then you're going to buy 300. Now that means if you don't just save up 300 and then blow it on a stock and save up another 300 and blow it on a stock, especially in this environment, because we're not really in an investing environment right now. I've talked about that quite a bit. But since we're not in an investing environment, work on your cash position. Build up your cash position. Cash is a position, especially to an investor. And to an investor, it is an exceedingly important position. Okay? So all of these things apply, but when it comes to really to investing and money management, remember as well, an investor, even the low-funded ones, you're a venture capitalist. Your risk-reward ratio is going to be so much greater than what it is in trading. It really, really is. So if you're going to risk, you know, $300, it's very likely that over time, with dividends reinvested, you can make 10, 15 times that. But like a venture capitalist, you're going to have some stocks, and I have that in my portfolio, that don't go anywhere and don't do anything. I still hold on to them because I hold assets that, well, I think will hold their value over time. But remember, you know, your risk-reward ratio is fantastic as investing, but it just takes longer is the only thing. Okay? So those are some things to keep in mind when it comes to investing and money management. And when we're in an environment like this, and it's a trading environment, and you're an investor, and you're thinking, I don't want to be a trader, Dan. I just want to be an investor. Build your cash position. Cash is a position. Build that cash position up. It's a little harder for me because I'm both. I'm a trader and an investor. But there's always something to do. There's always something that you can do. Build up your cash, and then it'll be a lot easier to only risk 3% of it, because you'll have more. Okay? Doesn't matter how much money you got. What matters is what you do with it. So it's just some things to keep in mind as far as investing and money management. Remember, you're a venture capitalist, so you're looking for the home runs, really. They take a while to develop. So those have just been my thoughts, not yours. Stay safe, invest well, and remember that love doesn't cost a dime.